So hi everyone, my name is Jordan and we are still looking at our series about chart patterns, and in this video we are going to be studying the rising wedge. So a rising wedge looks exactly what you are seeing on the screen. Right here we are normally on an uptrend, okay? And then the price it makes two trend lines which converge, okay? So that is what we call the rising wedge, just like you're seeing in this image. Or sometimes it can happen in a downtrend, and the price tends like as if it is forming, and then it forms this wedge pattern right here, okay? So we are going to be looking at different ways to trade this pattern, okay? So in a wedge, we have two trend lines that converge. So for example, if you want a clear uptrend like this, and then you construct your lower trend line and then this upper trend line. So when they converge together, to converge is to meet. When they meet together, that forms a wedge, this pattern right here. So in most cases, you have an uptrend, okay? And then you have this upper trend line, and then when you connect to this lower trend line, they tend to converge together, or they tend to meet. And when they meet, it shows that the volume of trading from within this uptrend is decreasing, okay? And the steeper it becomes, the lower the volume, okay? Because the price is making decreasing higher highs, okay? We have, remember in uptrend, we have higher high and then the higher low pattern. But when you're forming the wedge, you find that instead of this high, you find that another high is getting shorter and shorter. That's what makes the trend line to come and converge. So the wedge shows a pause in the current trend, and whenever we see a pause in the current trend, it means that the traders have not decided where the market is going to go. So what is going to happen is that it will take some time for the traders to determine where the market is going to go. But in most cases, if this pattern happens on an uptrend, it shows that the bears are going to take control, and therefore that's why you get a trend reversal. But in most cases, when it happens on a downtrend, it means that the bulls are going to take control, and therefore, sorry, the bears are still in control because the highs which are formed are decreasing, okay? You can see here that you have this high, and then this high is lower, and then the next high is lower, then the next high is lower. It shows that the highs are decreasing, which shows that the bears are still in control of the market. So when it happens on a downtrend, it shows that the continuation is going to happen. We shall be discussing this more in this video, okay? So when you encounter this formation, it signals that forex traders are still deciding where to take the market price, okay? So if a rising wedge forms after an uptrend, it is usually a bearish reversal. And if it forms during a downtrend, it could signal continuation within the down move. So a rising wedge formed after an uptrend usually leads to a reversal. And then a rising wedge formed during a downtrend typically results into a continuation. So what we are saying is that if you have a clear uptrend, okay, you have a series of high high and then a yellow pattern, and then you tend to form this wedge. When you form this pattern on an uptrend, it in most cases signals that we are going to have a reversal, and that is the image you're seeing right here. But when you see it in a downtrend, okay, and then the pattern forms in this uptrend, this rising wedge, it shows that the market is going to form a reversal. Why? When we are on an uptrend, okay, if you have an uptrend, you can see that right here, what happens is that the market forms a series of higher highs and then a yellow pattern like this. Higher high and then a yellow pattern. So to form the wedge, one high is going to start to decrease because we are going to form a trend line that slants. And then when we join this other trend line, they converge. So this decrease in the higher highs, it shows that the market is losing the bullish momentum. And therefore, in that case, it shows that the bears are taking control of the market, and therefore that's why we normally get a reversal. Then on the other hand, if you see that the market is on a clear downtrend, okay, and then we start to form this wedge. When we are forming the wedge, remember these high highs are decreasing, okay, you find that the first higher high, this one here, is higher than this one, and then this one is lower, then this one is lower, slightly lower. They tend to go on decreasing. So what happens, we are expecting that something like this, when this high is lower than that, and the next one is higher and the next one is higher, but here they tend to be decreasing. So this decrease in the highs shows that there is a loss of momentum. So even here we are having a loss of momentum from the bulls which are trying to reverse the market, and therefore we get a downtrend. So rising wedge can be reversal or a continuation pattern. So the rising wedge pattern can be traded using the breakout or the break and retest strategies. Okay, so let us continue and then see how we can trade these patterns. So right here on the candlestick chart, this is how the wedge looks like. If it is a rising wedge, we have an uptrend, and then the market starts to form these highs which are decreasing. They are not decreasing like this, but they are decreasing in momentum. Because when I say decreasing, they don't mean that they decrease, but they decrease in momentum. We expect that the high, which is previous, is significantly lower, and this one is significantly lower. But in a wedge, you find that the high, they are not significantly higher than the others. For example, you can see that this one and this one and then this one, they almost look like they are nearer to each other. So when you connect these ones with the upper trend line and then you connect the lows with the lower trend line, you can see that there is some little bit of converges at a certain time t. It will converge. So we expect that the market is going to come and then break out and then form a downtrend. So you can see that right here it happened and the market broke out. So here we have our entry point, and then here we have our take profit. So when we enter the market, we enter on the break. In most cases, we might not wait for the retest in this chart pattern, but if you someone who trades retests, you can wait for retests. And they don't happen, you miss that one. If they happen, well and good, hallelujah. So here you make the entry point, and that is of course a sell stop order, but still on the other case, it can break out in a reverse direction. If it happens in a reverse direction, you have to be a little more curious, because when we see this wedge on an uptrend, it means that this rising wedge, that the momentum of buyers is decreasing. But now remember, after forming it, we are expecting that the market is going to reverse. But now on this side, it shows that we are going to continue. If it shows that we are going to continue, you have to be more curious, because the pattern is telling us that a momentum of buyers has reduced. And remember, for you want to take that low momentum. So on the other hand, we said that this rising wedge, if it occurs on a downtrend, what happens is that we expect a reversal. So you can see that here we have a downtrend, and then right here we formed this rising wedge. When you form this rising wedge, it shows that the market is going to, because the difference between this swing high and this swing high and this swing high, the differences are not significant like we expect them to be in a clear uptrend. It shows that the momentum of buyers is weak. If the momentum of buyers is weak, it means that the market will therefore favor the bears, and therefore they will have to reverse the market, just like you're seeing in this image. You make your entry point here, and then you catch the first profit on this swing low. So on the next chart, we're going to be seeing our entry point. Okay. So when you look at this chart right here, we have a bearish reversal pattern within the rising wedge. So you can see that the market is on a clear uptrend right here. And when the market is on a clear uptrend, then it formed this high, but it is okay. Yes, looks significant from this one, but the next high is not significant from this previous high. So when we construct a lower trend line and then the upper trend line, they come to converge and then form that wedge pattern. So here what we wait for is for the market to break out of the pattern. And when it breaks out of the pattern, we put our sell stop order, and then we catch the take profit right here. This is the first take profit, and then we can come and catch the next take profit at this level of resistance here, and then the third one over down here. So where is the entry point? One, to avoid false breakouts, we agreed that when the market is going to break this trend line, we wait for a candle that closes entirely below the wedge. So we wait for for example, this is our wedge pattern. and maybe the market has been coming from an uptrend here, and then it formed a wedge. So here we wait for a candlestick that closes entirely below this lower trend line, and then that is when we put our sell stop order. So for example, when you look at this candle here, it did not close entirely below the lower trend line, so we could wait for the next candle, and therefore we could put our entry point right here to avoid false breakouts. So you can see that right here we could put our sell stop order, and then we target this level as take profit 1, and then from there we could also target this level as take profit 2. So in most cases what happens also is that when you have this uptrend and then you form your wedge, when the market breaks a wedge, it can retest it slightly and then go down. Or what would happen is that the market can break the wedge, okay, and then does not retest, but it comes back later on to come and retest on this level, and then it would still go down. So you have to also have that into your expectations. So we are saying that if the market is on this clear uptrend, okay, and then you construct your lower trend line and then this upper trend line, and then you see that the market breaks out, it can make a retest, that is one, and then it makes a short trade. Or if that doesn't happen, what would happen is that the market will not make a retest, but it will just continue to make a downward move. Or sometimes what will happen is that the market will make a large downward move and then comes back to retest on that level, and then it continues to drop. So you have to put those formations into your head when you're going to trade the pattern. So for example, you can see that right here we have our wedge, and therefore after the breakout we have not gotten any backward retest. But you can find that after the market hitting this level of support, right here we have a support level, the market will go back and then retest on that level and then come back downwards. Okay, so you also have to factor in this second level of retest as an entry point. So when the market makes this second retest and then you get a candlestick pattern, if you didn't watch my videos about candlestick patterns, I recommend you go back and watch them. When the market makes this candlestick pattern and a bounce off this bounce off of this lower trend line, it means that we are going to have a short trade, either back right here, or in most cases the momentum is big enough to break through that previous level of support. So our entry point is at this candle which closed entirely out of the range, out of the wedge, sorry, and then we could catch profits 1 here, and then we could also catch profits 2 right there, and then wait for maybe a reversal to go back and retest there, or to go back and retest on this level of support. So that is for the trend reversal. The market is on a clear uptrend. The market forms a wedge pattern, okay, and when it breaks out, we said 1, it can retest and then sell, or number 2, it will come and form the wedge, but it will not retest, but it will make a big down movement without a retest, and then it comes back to retest and then comes back downward. Okay, so that is for the bearish reversal pattern. Okay, for the stop loss is normally 1.5 of the ATR indicator, and then or sometimes it is above this wedge pattern if it is not wide enough. Okay, so you have to make sure that your stop loss is wide enough to avoid false breakouts which can come and retest and then they reverse. So we are going to be looking at the trend continuation within the falling wedge. You can see that we say that for trend continuation, it normally occurs on this downtrend. You can see that right here we have a downtrend, and then here we formed a upper trend line, and then this lower trend line. We can see that right now they have not converged, but later on, if you extend these lines, they will come and converge. So in the conversion, we expect that the market is going to be consolidating within this pattern like that. But you can see that the steeper it becomes, the more the chances of it breaking out of the pattern. So in most cases, in this pattern, you can see that we are trying to form an uptrend, but the uptrend fails. So if the uptrend fails, it means that the bears are taking control of the market. Why is the uptrend failing? Because of these insignificant swing highs. Okay, so for significant swing highs, we expect the market to push Fibonacci level, and then comes Fibonacci level, then Fibonacci level, like that. Okay, we shall look at the Fibonacci in the next videos to come. So you can see that right here after the breakout, we are seeing that the market can come and retest here, and then it continues into its downtrend. Or sometimes it will not retest, and then you just make a short trade to get your target profit. So right here, the market did not retest, and then it just kept on in the short direction. So where do we make our entry point? Entry point is at this candle which closes entirely, because now this could be a false breakout. So wait for this candle that entirely closes out of the lower trend line. When that candle closes out of the lower trend line, that is when we make our sell stop order from here. Okay. And then we go short to make that trade. So stop loss is 1.5 of the ATR indicator. Okay. Or sometimes the stop loss could be at the top of the pattern. So that is how we trade the rising wedge. Okay, so you can see that for the rising wedge, it is normally short trades. When you form of a rising wedge, you will only make short trades. So for example, I said we have an uptrend. Okay, we have an uptrend. So on this uptrend, we form this falling wedge. So when we form it, it means that the market is going to break out of the wedge, and then we make a short trade. It can retest, and then you get a short trade. Or sometimes there will not be a retest, but it will just go down, then comes back to retest, and then later on shorts. Okay, that is for trend reversal. That is when you get a bearish reversal on this uptrend. Okay, when it occurs on an uptrend, you expect a reversal from the bullishness into the bearishness. And when you get the rising wedge on a downtrend, and then you get your wedge, okay, it shows that the market is going to continue in the selling direction. So thank you so much for watching this video. I'll see you in the next video. Do not forget to subscribe to the channel for more videos like this and for support. Bye bye.